Hi guys, Max here, and we just had a really bad day for the markets. This is, of course, your market update, and things were really poor. In fact, that was the worst day for US equities in 2 years since the worst points of the 2020 COVID market crash. So just how bad was it all? Well, as you can see, it was an absolute sea of red. Moses would be happy to see all of this. Walmart was down at 7%, Costco down 12%, and this one in the corner here, Target, was down 25%. But more on those companies later, because actually retailers are getting absolutely hammered. We also saw tech perform awfully as well, of course. Amazon down 7% and Tesla down 7% as well. Tesla now trading at around the $700 mark, a far cry from the $1,200 it used to be sitting at. Financials were down, healthcare was down, industrials were down, real estate was down, energy was down, big tech and small tech was down, everything fell. It was an absolute bloodbath. Loads of people lost loads of money. What actually happened for the indexes though? Well, the S&P 500 fell by 4%. Again, that's the worst single day performance in over 2 years. You may remember about 2 weeks ago, I said that exact same thing, and this day was even worse than that day, which is why we're saying it again. The Nasdaq, of course, performed worse, as you would expect, with these awful tech giants falling by 7% in a day. The Nasdaq was down by 5.1%. And the old world industries from the Dow Jones did poorly too, but not quite as badly, only falling by 3.6%. The rest of the world then, how did we see markets perform in Europe, for example? Well, not well, as you can see. The UK, the FTSE 100, the 100 largest listed companies in the UK, fell by 1.1%, and the Stoxx 600, the equivalent for the rest of the continent, fell by 1.1% too. It wasn't good in Canada, it wasn't good in China or Japan either. So we saw the MSCI World Index, or basically a compilation of every single stock in the world, fall by 2.7%, a really poor performance. Now, what happened with currencies? Well, the same sort of thing that's been happening a lot recently. As stocks fall, the dollar strengthens, and foreign currencies tend to do a little bit worse, and that happened exactly the same yesterday as well. The Bloomberg Spot Dollar Index, which measures the US dollar against a myriad of other currencies, rose by 0.4%. The euro fell by about 1%, and it now sits at about $1.04 again, once again getting really close to parity. The pound fell by about the same margin and is back down to $1.24 again. But the yen actually bucked that trend a little bit and rose by $1, now sitting at 128 yen per dollar. Bonds saw some inflows, bucking that trend that we've seen recently once more, with yields falling and prices rising. The US 10-year Treasury yield fell by 9 basis points, and it now sits at 2.89%. We saw similar moves for other bonds by other countries, but not as volatile. German and British 10-year yields, for example, both fell by 2 basis points each. Oil prices fell, which is really nice to see because they've been getting damn high once more. They were sitting above $110 a barrel again. WTI crude oil, though, fell by 3% and now sits at about $109 a barrel. And Brent crude oil is sitting at $110. Gold prices saw a very minor rout, falling by about 0.2% for the day. And per ounce, gold is now sitting at $1,820 once more. Finally then, for the strict market recap of today, what happened in the crypto sphere? Well, as you can see, things were not good. Bitcoin fell by another 3%. It's now sitting at about $29,000. Ethereum fell by a little bit more. It's now sitting at $1,900, down 5% for the day. Altcoins performed a fair bit worse, actually, with most of them falling somewhere in the region of 5 and 10%. ADA fell by 10%, Sol fell by 10%, and XRP down by 6%. Most stablecoins are maintaining their peg, even though there is, again, lots of fear surrounding USDT, Tether, whether or not it's backed, it isn't, and whether or not it will break its peg. So yeah, that's basically what happened for the day. And of course, it was awful. That was a really bad day to have any money in risk on assets anywhere. There really wasn't any respite. Even consumer defensives, which for the last few months have been performing comparatively quite well, especially when you're comparing their performance to something like tech stocks. Well, consumer defensives really didn't do well either. So why were stocks so bad? Well, there were two main reasons and then a couple minor ones as well. Now, the first one, and the thing that's actually new and interesting to talk about, is this idea that inflation is high. It's going to keep getting higher, and historically, inflation actually eats away into companies' earnings, but this cycle so far, that hadn't really started until this week. We got some earnings reports and some new developments from companies like Target, Walmart, and Costco, and in short, higher inflation is making their costs rise while their revenues aren't rising by that same amount, so their profits or their earnings are falling, and that's awful for valuations. As I just said, Target, Costco, and Walmart are the real big losers here, but we are going to talk about them more in the future. The reason this is so worrying for the markets, though, is people are now expecting this sort of effect of higher costs leading to reduced earnings to spread out into the rest of the market, to hit the tech market, to bring margins down for SaaS companies, to impact oil and finance and Apple and everything that for a long time seemed almost immune to the negative effects of inflation, only pocketing up the positive ones. Now, the other really big fear is, once again, of course, a Fed hard landing, where the Federal Reserve is trying to tame this inflation because it's damaging the economy, and in doing so, they cause a recession themselves. Now, I have come out and said that I think this is practically mandatory at the moment. It is not really possible anymore to tame inflation without causing at least some small minor recession. In reality, it's probably going to be even worse than that. The markets are finally reacting to this, with the Federal Reserve finally acting hawkish as well. Powell has said that he's now happy to raise interest rates above the neutral rate, which is assumed to be around 2.5%, in order to curb inflation, to bring the economy slowing down, and to make prices fall again. As these rate hikes rise, a recession is very likely to be caused, which is actually a brilliant way of taming inflation, even if it does cause some short-term pain. Now, finally, the minor reasons are the same ones that we've seen for months now. The first is the Russian invasion of Ukraine, poor geopolitical issues, energy supply crises, things like that. And the second one is, of course, from the other giant, from China, from their lockdowns and the impacts that that's all having on supply chains and everything like that. Now, talking about Target, Walmart, and Costco in particular, what actually happened yesterday, what led to these massive losses, and what's really going on. Well, Target fell 25%. Its share price fell by a quarter over the course of one day, and it was a $100 billion company, so that is not a small rout at all. In fact, that's the worst single day for Target in about 40 years. Back from the 1980s is how far you need to go in order to see performance that poor. So why was it so bad? Well, they posted their earnings and it was a really bad report. There was a slight revenue miss, but a huge earnings miss of about 30%. Now, how did things go so badly for them? Well, there was a huge rise in costs that was pretty much just unexpected for them because of the effects of inflation and the supply chain crisis that is still ongoing and has been for years now. They did see small sales growth of about 3%, but that's a minor amount and it actually missed expectations as well. And when your earnings are dropping by 30%, revenue growth of 3% really isn't that much of a consolation prize. Basically, we're seeing inflation eat away into their profits, and so the share price tanked. And really, it caused a rout across similar companies that also work in retail, because if this is happening for Target, the chances are it's happening for their competitors as well. Now, what did they have to say? Well, CEO Brian Cornell came out and said that the company missed the mark as its gains were accompanied by unusually high costs. While we saw healthy top-line growth in the quarter, we were less profitable than we expected to be or intend to be over time. Now, as I just said, seeing Target be impacted by inflation like that, we should expect their competitors to be impacted in the same way. And so Walmart has had a bad day too. They have now cut their forecast for their profit. Their share price fell by 6% yesterday alone, not quite 25%, but not good either. They came out and said that US inflation being this high and moving so quickly, both in food and general merchandise, is unusual. We knew that we were up against stimulus dollars from last year, but the rate of inflation in food pulled more dollars away from general merchandise than we expected, as customers needed to pay for the inflation in food. And finally, another competitor of Walmart and Target is, of course, Costco. But what's interesting here is that Costco haven't come out and said anything or reported anything or cut their earnings at all. They've just seen a 13% decline over the course of a few days, purely on the idea that they must be seeing the same sort of effect, even though they haven't come out and said it. Now, this is really bad for these companies. Let's not get it twisted. Them losing their earnings and seeing their profit margins eroded away is bad for these companies and for their investors. But there is one very minor silver lining here that actually this is a good thing in regards to inflation. What you just heard there from Walmart was that people are not spending money on discretionary items because food prices have gone up, so they're having to spend money on food instead. And this is what we call demand destruction. And actually, it's supposed to happen when we have inflation. The good thing about it is that in the long run, it will actually serve to reduce inflation. People are no longer wanting or able to spend all of their money, so demand for products falls, so prices fall with them, bringing inflation down. This is good and expected, and actually if we don't see it, which we haven't really up until this point, that's when you start to fear stagflation, where the economy goes down into the toilet, where you see a recession and really high unemployment, yet inflation maintains its really high rates. The fact that we're seeing this now with retail, with some of the biggest retailers in the world, in the US especially, well, that's good news for inflation because it does mean actually we may be nearing the top. I don't think we're quite there at the top or the peak yet, but we are probably only 6 months or so away. This is a pretty hard idea to get your mind around. How can companies making less money be good for the economy? But in the long run, I really do think this will turn out to be a good thing that we're seeing. Now, the final company we're going to talk about today is Cisco, who is a huge American tech company who source a lot of parts from overseas and China in particular. Now, Cisco's share price is down by 19% after market, after warning that sales revenue was going to be quite bad and maybe actually down negative growth of 5%. Now, why is it so bad? Well, in short, because China's lockdowns are making the supply side shortages even worse and they can't fill the orders that they want. They're expecting revenue growth of about 2 to 3% for the year, which is really quite poor. Now, Cisco are looking at the silver lining, as you might expect, and they came out and said that even though these top line numbers don't look good, there's a very simple explanation. Customers are not signaling any real shift at this point. There's no reflection of demand issues in our guidance. Basically, what they're saying is that this is their own issue. This is their issue in producing the parts and selling them to customers, not from customers buying them. And this is bad news for inflation. This is the kind of thing that stimulates an inflation spiral. And this is one of the reasons we've had such ridiculously bad inflation over the last couple of years because of the supply chain crisis. Now, finally for today, we're just going to talk a little bit about Sri Lanka, that South Asian country, which is about to default on about $12 billion worth of debt, it seems, and there doesn't really seem to be a way out for them. Now, this is interesting and important for the country itself, but it's also important for other developing markets where this could be setting a precedent of countries that might also find themselves in positions looking like they're going to default on their sovereign debt as the recession kicks off and as it spreads across the entirety of the world. This might be worth an individual video itself explaining what I'm talking about there. Let me know in the comments down below if that's something you'd be interested in. Now, talking about defaults, Russia is probably also going to default on some dollar bonds that it owes, but this isn't really their fault. It's not because they can't pay them. It's because the Biden administration is likely to put into place a law which would ban people from taking payments from Russia in the form of dollars for these bonds. So Russia would be basically having a gun pointed at their head, forcing them to default on their bonds. Now, this means that it isn't really a representation of Russia's ability to remain solvent and pay its debts, but it will still impact Russia negatively. It will make it very difficult for them to take out financing in the future if there's literally laws against them paying out that financing. I personally wouldn't buy a bond if I had the government telling me that I'll go to jail if I receive payments for those bonds. It's not good for Russia, but it's not exactly the end of the world either. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help out. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord server and exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. Of course, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists like Banksy. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource of the markets, crypto and stocks falling every week. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get interest on your crypto, so it's earning you money while it sits there. Thank you all for watching. Stay stoic. Until next time.